9:53, right? We're going to start this meeting a little early so I can get out early too. So we're going to get out to the masses by teaching IUL sales. So let me get what I need together here, guys. Let me go here. I need to print something up, so give me a second. Give me 1 second. I just need to print something out. It's wrong. Hold on 1 second, guys. I got to print this out. Maybe I can just share the screen too. Let me see if I can do that. Ah, there it is. Okay, I got it. Let me print this up because this is the Index Universal Life product that I'm going to review with you guys, and I'm going to teach you how to pitch this, sell this. I mean, there's a ton of people that this can be sold to. When you're in there with the seniors or 30, 40, 50-year-old people that have children, this is a great product for their future too. So guys, there are no more, there's no more pensions, there's no more 401ks. Social Security, you're lucky if you'll get it. So if we don't start teaching people about this right now, the future may be doomed. So let me show you how to read over this and get on this. The webinar is also on, so for those of you that want to interact, it can also be part of the webinar that's on here too, if you want to interact with let me get a pen and we'll get started. So what we're going to review is basically we're going to go over Index Universal Life's, what products I feel are the best, highest interest earning ones, and we're going to prove it too. We're going to look back into the history of these products so when you're talking to your clients that you can provide them the information that is necessary to create the sale, which is proof. When you do IUL sales, people can listen to you. Remember, this is the first time, 9 times out of 10 is the first time they're meeting you, so their trust is, report to the point of trust is huge, person to person, but report to the point of trust on this product is even bigger. I mean, they got to trust where they're putting their money. Just like a bank account, a savings account, something like that. All right, so we got the IUL here. Should be the cash value portion. So inside here, we'll review this in a second. I'm going to go over this and how to get these illustrations out to people. Now, I've used one product here, and I'll tell you about this product. This is F&G. And we're going to go over how to read this over to individuals so you understand that they understand what you're talking about when it comes to Index Universal Life. So Index Universal Life's want to take people's money from here to here. So if they have 60K in this, even with the cost of insurance, it should be 130K at this point. It's usually doubled after the 20th year. So 10 doesn't really do much, especially on low premiums. So what I teach people to do is I tell you this is the biggest sales you can make too, or finding individuals, 30, 40, 50 years of age, even 60 years of age that we use this product for financial future, for death benefit and living benefits, also for the tax-free retirement portion of it. So in this, we'll go over, this is going to be tough to see, so I'm going to have to get close to the screen when I do that part. So what we're going to talk about is this portion of the puzzle is discussing their premiums are going in here. For 10 years doesn't really make any sense. For the 20th year, they got 60,000 bucks. This thing's worth 130. This premium is about 300 bucks a month to get here. 3,600 bucks a year, they can get to this and have that in about 20 years, and so can you. So this will deflect the cost of insurance, the higher premiums you rate. You can overfund these too. So you can contact the company and you can put an extra $200 a month towards this if you do not have it overfunded. There is a scenario where you have to switch it from B to A to get the income for as long as you want. So let me erase some of this so I can review this even better with you guys. Give me one second. So what we're talking about here is index universal life and the sales that can be made on a weekly, daily and weekly and monthly basis. Annually, you can make a ton of money doing this because it's a whole different demographic. It's not the final expense market. It does have something to do with the mortgage protection market. It can be used as a final expense product. It can be used for a mortgage protection product. But basically, I use it for the retirement basis of it while I'm protecting the mortgage. But remember, my lead is based on mortgage protection or final expense. It doesn't matter. Let me review this with you here. So this will give you an idea of what we're talking about very quickly. Let me get the cash value sheets out so you guys understand how I'm talking about. I'm going to review this. Give me 1 second, pull this up. Okay, so here it is. I'm going to have to pull these two screens together somehow. Let me do this screen first. I'll do this screen second. This is the cash value portion of the sheet. This is a person whose face amount started with $59,735 of a premium of $300 a month. This is a 52-year-old healthy male with non-tobacco. This is a ledger of him starting at age 53, putting $3,600 a month at the product over here, and funding it to a portion where he wants it at age 72 at $68,800 he'll have inside it. Now the death benefit is now worth $136,000. The cash is worth $189,000, and the account value is worth $112,000. So it did basically double on the account value portion of it. Here's the portion of the puzzle that's kind of cool. Is when he starts drawing, he wants to draw this until age 82. Okay, so he's going to pull $10,000 a year out until that day. He put $64,000 in, but age 82. Now he wants to take it to age 85. So by that time, he's pulled almost $200,000 out of it. So that's the interesting part about this is that when you design these products correctly and you can reflect cost of insurance, you can get individuals and yourself a great retirement schedule put together if you fund it correctly. It must be funded correctly. Hey guys. Okay, I don't know if anybody's seen what I was going over, but I'm going over the index universal life products, and we're going to discuss the value portion of the puzzle. I don't understand why it keeps. We're going over the cash value portion of the puzzle. I'm going to start over since some people got involved just now on this, and we're going to start from the beginning again. I'm going to review real quickly what the hell we're talking about today, guys. Here, we're talking about index universal lives, okay? And using index universal lives, there's a market out there that is untapped. So you get your final expense leads, you're averaging between, I guess, 15 to 22 bucks, depending on the organization you're with. Mortgage protection, you're averaging anywhere from, let's say 40 bucks, 40 to 50 bucks. So you're inside, this is the resource you're using to get inside the house, okay? Now you're inside the house. You're building rapport to the point of trust with individuals. Usually this is my market, but either one of these markets you can use an index universal life or a UL, which is a universal. Now, great products here are the GUL. Write this down. The Smart UL. Now, GUL has GUL and GUL Express. You're going to want to check both of those out. The Smart UL. The Smart UL, this is fixed at 3%. So this is not what we use for retirement. The Smart UL, however, is between 4% and 6% over the years, but has no cap. So it can go as high as it wants to go, as high as the company can possibly take it. The index universal life that we're talking about today at F&G has been averaging about 8.7 to 9.7% on the cash value. That's why on the 20th year, that the number, whatever you placed inside it, has doubled. You place 60 grand in it, likelihood of the cash portion of it is going to be $120,000. That time when you start taking money from it, you started it, let's say you started at age 50. Let's just work off this way here because one of my reps is using this. You start at age 50, you go to age 85 or age, what the hell we set it to, age 70 or something like that. We set to age 70. You start pulling money out at that time. So you have 130,000 in it, but you pull over 200 out over the year. In your period, you pull $200,000 out of it. That's the interesting part of the puzzle. And guess what? It's tax-free retirement. There are no taxes paid on that portion of the puzzle. I'm not going to go over the taxation part of this. I want to stick to the more salesy side of this, and we'll review that one-on-one if you guys want to talk taxation on this. But as to review this again, I'm going to bring this closer to the screen here so you guys can see this. So this is the portion of the cash value puzzle, okay? This is a part of the illustration that you will print out, that you will be having inside the client's house. Now, there's a few pages involved in here, and not many of them matter. You should read this over, other than this when you're pitching this. So at the end of the day, you have this. Let me see who's in the way. I can't believe this is. Okay, I got everybody on. So at the end of the day, this is what means most. What they're putting in. This product starts at $59,000. This individual started at age 52. It says 53 here. It's the closest year of age. So if they have, you have to ask them their age. Whatever age they're closest to is what this product will be based upon. So they're stuffing $3,600 a year in until, let's just go down to age 72 here and make it easy on me. They got $64,000 in. And remember, the policy started, this is increasing. This policy is designed to increase the death benefit as you put cash into it. So now the death benefit is $136,000. The cash portion is $89,000. The account value is $112,000. That's the part of the account value is like the indexed annuity. That's where the piece of the puzzle comes in under income. That's the part of the numbers you're supposed to be talking about. This side of the puzzle says non-guaranteed assumption current interest rate is 7.98% in the year. Now, bottom end on this product is 0.25. A fixed rate on this is 4.75. This comes with living benefits. Cancer, heart attack, or stroke. You get any of that, they get the cash value while they're alive. They want to cash it in, go down to cash, the surrender value. They want to know how much they're going to be getting for the rest of their life is part of the accumulated value. Now, this part over here tells you what they're for the rest of their life. So over here, this guy's got $64,000. He starts taking $10,000 until age 85. He's taken by age 82, $128,000, but he's only put $64,000 in. You understand that? Let me change this for you. So what he's, God, damn, there's people in the waiting room. I don't know how to set this waiting room shit up. So give me a second. Okay, so he's got $64,000 in. He's pulled $128,000, and he got what 3-4 more years coming to him. So he'll pull close to it's $10,000. Yeah, he'll pull close to $200,000 out of his product, putting $64,000 into it. That's because while he's waiting for his income, which is tax-free, by the way, he's capable of pulling money and it's still earning interest, just like the index annuity market. So, and he's not paying any more premiums on it. This is a great product too for people that want to pay in for a certain amount of years and then let the cash value pay for the product for the rest of the years. So remember, as long as these are overfunded correctly, they will deflect cost of insurance in the years to come because of interest. You need high interest rates. The products that I replace that are index universal lives today, that are 20, 30 years old and have cost of insurance that's too high and interest levels that aren't high enough to keep up with them, are the ones that I take off the table because cost of insurance is chewing away at the cash value. So there's only $3,000, $4,000, $5,000 left in the cash bucket. If the cost of insurance is $100, $200 a month, that gives them what, 2-3 years left on the product. So one of the biggest sales you can make is also replacing index universal lives. But these, the way you will design these is for income for life, or not income for life. It's going to be stated for income for life, but it also can mapped out for income until whatever age you want it to be. So it's a great product to use from that portion of the puzzle. It's fantastic for the demographics that we're going to talk about here, which are basically your mortgage protection leads and final expense. But inside these homes is what I want to talk about right now. I just want to give you guys a couple sales ideas, and I'm going to take some questions. So when you're inside the home, there's a whole market base. So if you're selling to 30 to 50-year-old people and you have that demographics going on, even 60-year-olds of age, this product will work. You can use an IUL for these individuals for their stuff. Now, these guys got newborns too. Without these parents' help, these newborns will not have Social Security, no 401k, no pensions. It's just not going to happen. They're just not out there today. Companies can't afford it. They don't even want to do it. And the companies that can't afford it may do it. But, the 401k ends up, what do I see out there basically? I see $100,000 to $200,000, and I see people that have to live, what, 30, 40 more years on this earth? People are living longer. The new 85 is 95. So you got to make sure that you're funding these people to the right time period. Do not go to 85 anymore, go to 95 and have them overfunded. Some of the strategies me and my group were talking about yesterday are real simple. They're this. If you go into a home and you know somebody has $250 a month and they're simply going to pay for a policy at that rate for their retirement, that's not very good. I mean, that's like a 401k basis, but the 401k might be matched. So that's a different product. So what this guy needs to do is get this thing to $500 a month. If you can start getting clients to higher rates, I'm going to tell you what, you will find money. People are doubling up on their mortgages. There's money to add to that. They're putting money in the bank. They're just simply wasting money. They're spending money that they don't need to be spending on anything else but their retirement schedule. So if you get these people involved and share with them the fact that they do have the money, they will spend a ton of cash on these products, overfund them, and get themselves a great retirement schedule. Tax-free retirement. It's not like the 401k. When they draw it, they get a bigger number than most of it. You put this side by side with the 401k. Let's say somebody pulls $1,000 out of a 401k, they're going to be taxed. This is tax-free. They get the whole $1,000. So that's the great part about tax-free retirement. Patrick Kelly has a book on tax-free retirement. It's called Tax-Free Retirement. I suggest you all read Tax-Free Retirement by Patrick Kelly. Along with the indexed annuity market, which you guys will find too. But these products are so fantastic. Think about this. There's a whole market out there untapped. Everybody's chasing around seniors. Nobody's ever talking about the children. I do. I get extra sales out of kids. I have homes where I'll go in, I'll get 3 to 5, 6 kids on this program. And it might not be this particular product. It might be a SmartUL or GUL sometimes too. But at least these kids have a fighting chance of doing something. They have something for their future that they can either take over or their parents can fund for them. And I tell parents how to fund this. They can easily take money from these products too out of the cash value interest earnings. If you're at 8.7, 9.7% interest rates, they can touch money in this without busting up the policy too bad. And I want to show you. I'm going to show you proof of this. Here's the proof of the history of the policy. This is 20-year look back. Okay, so this is what you would also. These two sheets are very vital to sharing with individuals what the products have. Facebook. I'll come back to you in a second. Let me show this right over here. So. You got the S&P annual point-to-point 100 participation. The top cap on here is 14.5%. So they can actually earn 14.5%. The averages, says down here, 10-year average has been 9.3%, 9.32%. For the 20-year average, it's been about 7.65%. So here in this product right here, you're able to show through the company the history of the product and prove that this is the kind of numbers that they're going to be provided in the future. And you know why? Because if you think about the past 20 years and this thing earning close to 8% interest, we've been through bad times in the past 20 years and 10 years. So this company's still been providing interest rates like this. I only see the interest rates going up, not down. You can't lose a penny, so there's no downsides to it. There's also the living benefit factor, so you as reps need to pitch this too. There's 3 parts of this puzzle that you need to be aware of, and here they are. This is very simple. Very easy sale, a lot of benefits. You obviously have the death benefit. That's what everybody thinks you're here for, is the death benefit. But then you add in, oh, by the way, this comes with living benefits too. So you get all the money if you've got cancer, heart attack, or stroke, or if you can't walk, talk, bathe, eat, dress, toilet, transfer yourself around, or even drive a car for that matter. the money becomes yours, a portion of the puzzle becomes yours while you're alive. So number 3 is the retirement schedule. I use all my products are based upon every product I sell. I always bring that language in. Every product I sell is good for 2 people. Now, I'm going to put this on Mr. Jones. Let's say that this is an increasing. That means that we start a $50,000 death benefit. He's paying $300 a month. But in 20 years, it's worth $150,000. Okay? So I got this on Mr. Jones. If Mrs. Jones passes away and he doesn't need this anymore, he'll just cash it in for whatever the cash accumulation is. Whatever that accumulation in cash value is, he just brought if he wanted to. And remember, the most important part of the puzzle is report to the point of trust with you, and then report to the point of trust on this product. They got to trust the product even more than you. Is that coming down to the olden days where you could walk into a home, make somebody like you, and sell a $30 product? That's not how this works anymore. You want to sell big numbers, you better have your ass trust. They better trust the product along with you, okay? So there's 2 sides to selling big numbers. Report to the point of trust with you and report to the point of trust on these products. Very simply said, these are fantastic ways to sell to younger people. They really are. And I go to age 60. I wouldn't sell this to 70, 80-year-olds. They probably won't even get through. There's health checks on this, so they got to be basically healthy. Non-smokers, smokers will let through. There are some light medications that will let through, but you got to be really, really, really healthy to try to get this product on something. And the basis of it is, again, would be for death benefit. You're there for mortgage protection, so it's going to cover the mortgage. But sometimes a rep's smart enough to make the mortgage not as important as retirement. People fear running out of cash more than they fear death. So think about that. You're standing in front of somebody that fears not having enough money more than they do death. And everybody fears death, the unknown. So our job, if you're a professional, you don't need to learn the products inside and out either. You need 2, 3, 4 pages out of that damn pack that I showed you on the illustration, and you need to provide them the information inside it from the cash value point of view, the death benefit, the living benefits, and the retirement schedule. That's it. This, most importantly, they're going to want to know how much money they're going to give you annually. So in this case, he's going to get under that stipulation of $300. This guy's going to make $200,000 putting $64,000 into a product. You think that's a good thing, right? That works. That's a fantastic thing. So even on your own self, think about $300 a month that you blow, that you could have for later on. Now, of course, this takes 20 years to get to this point. So for older people, they would have to fund it a lot higher, but they're funding these things in the wrong way anyway. Here's how. Some people don't need sometimes they don't need their Social Security, 401k. They don't need these draws, but they're forced at 70 and a half to take them. So this is another place at 70 and a half to take the money. Let's say somebody's got $2,000 a month coming in, and they just don't need it all. They want a place to replace this and put it towards tax-free retirement. TFR. So when they remember, you're going to run into people if you do enough of this, that you'll meet people that are forced to take their retirement that want another place to stuff the money. And this is a great policy to sell under that stipulation. Even the smart UL or GUL. Doesn't matter, as long as they have a place to stuff their money. Think about the death benefit on $1,000, even if you're older. It's got to be $250,000 to $500,000 on an old person, on older individuals. And for younger, it could be $1 million. So it's a fantastic strategy, no matter how you design it. Just be inventive. Be inspiring in the home. Be inventive. Be creative. And think about their retirement along with the coverage of the home. I don't want you guys just thinking about now for these people anymore. Think about the future for them too, and it will add premium numbers like you can't believe to your policy, because that's what they want to talk about. Nobody's ever talked to them about it like you will. Not even their financial advisor can share with them this. He doesn't have it. He can't sell it. All he has is products that charge them money. That's it. Fees. Tons of them. Now look, there's fees involved in many IUL products, but the performance of a high interest rate earning product will deflect them. The proof is in the sheet. Here's the history. This is the history. 10 years, 20 years, it's the history. It shows it. It provides you the information you need to share with them the fact that, hey, yo, at age 72, even, well, we set it for 70, you're going to start getting $10,718 a year until you're age 85. You put $64,000 or less in, actually put less because he started at 70. So he's got $20,000 less. He's put like $40,000 in this, and he's getting $200,000 out. How the hell is that possible? That's incredible. You know what I mean? So he can cash it in. He can use it as death benefit. Gets cancer, take the death benefit. But it's mainly designed for retirement. Very important subject to talk about inside the house. I talk about it all the time. Every home I'm in, I always discuss retirement. In fact, sometimes I've learned to train myself not to mess up, because when I used to talk about retirement, they'd be confused and say, well, I thought you were here for mortgage protection. I am, because this is a mortgage protection product, but what it provides you with is retirement after you pay off your home. Some people are going to make it to the point where they do pay off their home, okay? So this is an extra retirement schedule. If you do the math on many people and they're not doing the math themselves, and you take 4% annually as inflation, and most of these people are only earning 3 to 4% annually. Some of them will tell you I'm earning 8, 12%. Meanwhile, their freaking stockbrokers taking 3 of it, and they just don't see the fees involved. So the truth of the matter is they're usually earning 3 to 4% interest, and they're not deflecting inflation. They need another product in place. But they can use this retirement to fund this. People, the older people have money. Most of the time when you're running into situations through a mortgage protection lead, you're dealing with our demographics based on our leads. You're running into a lot of people. 50% of the people I run into can get this product when I'm on the field. 50%. If not this, a Smart UL, which is the downside of this, it's a little less interest, but it does the same damn thing. I had both. I got Smart UL, I got this. You can have LSW too. LSW, by the way, has the most living benefits. But if you're selling on retirement, living benefits aren't going to work. You're still on retirement stuff. So let me ask you, let me break this up a little bit right now and ask, are there any questions to this point? I got to check. Any comments, any comments, any comments? If you have a comment, just post it here and I'll answer it. Give me a second to take a drink here. This is fantastic for you to have another, it's another resource. We have so many strategies as a broker to sell that we don't even use them all. We don't even utilize half of them. All we focus on is covering the mortgage or final expense. We leave all this money on the table. When you're a professional and you get really, really good at this, you start taking in the factor that, well, they do have a retirement. Their children have a retirement. Their grandkids are going to run into this. They're even going to have it worse. Think about it. 10 years from now, things are 40% higher. I mean, what the, you know, come on. That's incredible. So we have an average of 8% annually on a product, okay? Now, this is going to be cost of insurance. It starts light in the beginning. You go 20 years down the line, and it's $100 a month will be probably coming out of the cash value. But at that portion, that's not a big deal, and it probably goes up about $10 annually. You guys need to know what COI means. You need to write that down and remember that. COI means cost of insurance, and that's a delicate discussion when you're having it with somebody who has a policy existingly and you know it's rotten, it's no good. Cost of insurance chews away at the cash value of the product later on. So let's say this person thought that they had a $100,000 policy, and I run into this all the time. They have a $100,000 policy. I want to remind you something. When you're asking people if they have a product, and they say yes, you say, you always say it like this. You say, so what does it pay to Mrs. Jones? What's the payout? Don't say, so what's the value of it? What's the face amount? How much is it worth? You always want to let them know you care about the woman. How much does this pay out to Mrs. Jones? It pays $100,000. Anything over 40 grand, you automatically know it's either term or an index universal life. That's it. That's all that was sold back then. That time, it's always that way. Anything over 40 grand is term or index universal life, period. If it is term, you know it turns out. Easy replacement. I'm just going over this for a few people in the field. So give me some time on this, and I'm going to review some things with you. Number two is the IUL. So you got the IUL, which comes with cost of insurance. This guy's got $5,000 left in his cash value because he didn't know the cost of insurance was chewing away. This is what we deflect with our higher interest rates. So his product came with 3%, 2.7% annually. And that's why the cost of insurance will chew away at the cash value portion, because it didn't earn as much as our products have been proven to earn for a 20-year period. Remember, it's proven in the history of the company to earn this style of cash flow. Okay, so as long as they don't F around with the product and so on and so on. So the bottom line is, go into homes, find products, replace them, and use the existing premium for your new IUL. I'm taking people out of IULs and put them back into an IUL. They're like, well, wait a minute, it comes with cost of insurance. Well, sure it does, but you're starting over. Remember, this cost of insurance didn't start happening until 20 years down the road. You're 60 years old. By the time this kicks in, you're going to have enough cash at 8 to 9% interest annually, and even higher, that you'll have enough cash to deflect COI, which you guys now know means cost of insurance. Okay? Now remember, any questions you have, just open the mic up. Hi, Jay. How you doing, buddy? Now, let's slow this down a little bit. Where we started was, we have a mortgage protection lead 9 times out of 10. You can do this on final expense too. You run into an individual who's just like this individual, 52 years of age, okay? They're a 52-year-old man. There's a cover sheet. So I don't know anything about them, but a lot of you don't know this, but sometimes when you walk out of a house, that's it. They can talk to a stockbroker, they can do this and that. A lot of times I will get this information printed right at their home. Mr. and Mrs. Jones, do you have a printer? Do you have a computer? Do you have a printer? Yes. May I print? I'm going to print the illustration up to show you factual proof of the history of this product and the future of the product. So I want to provide you the information necessary so you can have a retirement plan put in place. And IUL, they don't know what that means, Index Universal Life. The indexing is what we use. The universal is the portion of the puzzle that we can leave the premiums alone. If they get into a jam, they don't need to even pay the premiums. The premiums can come out of cash value. So the universal part is very interesting. We have the life insurance part of it, so it's a death benefit also. But this also stands for living benefits also. The L stands for 2 things: life, which is death, and living benefits. You've got the indexing market, no downsides. Low points are going to, just like any other product on earth. Look, I can't help it that these people started late. Like me and my partner were talking about yesterday, it is what it is. They started late, it is what it is. You can't help them, get back to 30 years of age, but what you can help them is with the next 20 years. Because the fact is, if this guy's 52, he's going to be 72 one day. He's going to be 82 one day. He can either have that, be satisfied with 100 grand, or he can change his game plan up with the help of the rep. And that's the rep getting him from $300 a month to $500 to $1,000 a month. How do you do that? How do you get somebody from 300? The sale's good. You feel good. You're making what, $3,600 on average? You make a little less on these IULs. But long story short, you make $3,000 or so on this. At the end of the day, you got 500. You could make $6,000. You could make $12,000 on this deal. Now, why? Because it's the right thing to do. Also, at $300, he's not going to have much money. We can do the math. That states he put $64,000 in. He'll have about $100,000 in 20 years. If we double that, he's going to have $200,000, which means he'll be able to take not $10,000 a year, but $22,000 a year. That's $11,000. He'll be able to take $22,000 a year out until age 85. This is all this guy. This scenario is interesting with me and my rep are working with, because this guy actually gave what the hell it is? He gave somebody $150,000 of his own money to put into the market, and the guy ran with his money. That was just all he had. He's starting over. But when you're in the field, you are the creator of their need. They don't understand the need. They think you're there for mortgage protection, and you are. This product provides protection for the mortgage. I also told the rep to ask, you know, a lot of you don't ask this, but this is an important, vital piece of information in a home. Mrs. Jones, if God forbid something were to happen to him, would you even stay in this home? Would you live here? Now, in many states like Florida, they say, no, I get the hell out of here. I'm going back up north. I'm leaving. You need to ask her if she's staying in the home. You might be surprised that you can get lower policies. Remember, this is an increasing policy. It means it's based on retirement, not death benefit at the beginning. The death benefit grows over time. But the cash portion is what he's looking to get so he can retire. He's got 58 grand he's starting with. He gets to 200 grand later on. That's how he wants it. Okay? It's based on retirement. Long story short, the good news is it's like this. If you told Mrs. Jones, I'm leaving the house, Jason, okay, that's great. She only needs 50 grand to sell the house anyway for the equity in. You guys need to protect these people, but you also need to tell them about the equity in the house is what they can protect also, not just paying off the home, along with paying off half of the home. But this is the truth. Most of these people will probably live 15 years, 20, 30 years. Let's go 20 years on an older person. 20 in 25 years. There's 5, 10 years to pay on the home. They only need a smaller number like 50 to 100 grand. Trying to get people $300,000, $400,000, $200,000 to pay off a mortgage is tough because of premiums. It just doesn't happen. So as a mortgage protection professional, you need to come up with other theories and concepts to protect these people, which is paying off half the mortgage. Look at the back end. Later on down the line, protecting the equity, making sure Mrs. Jones walks out the door with the equity. Mr. Jones, if she's dead, you now have a retirement because you lost her Social Security income. All these things matter. One person dies, there's an income loss. Now remember, they get the two of the higher Social Security incomes, but I always tell Mrs. Jones, for you to get his Social Security income, Mrs. Jones, you realize it takes 6 to 12 months before you receive his Social Security income. Now, if she's based on $700 a month and the mortgage is $1,500, how the hell is she going to pay the mortgage? She can't. She's doomed. She's doomed anyway. So people are always trying to get big numbers. So don't fail yourself by thinking that you have to cover the whole house. Go into the home and protect what you can with the premium that's in the budget. Period. Don't try to force more on them. I don't force more on them. You can explain more. You can tell, don't sell, because the product sells itself. The future of this product for the protection of his income needs at retirement, protect and sell. You will get this deal. He doesn't have anything else. There's nothing else there. What else is he going to do? Start a 401k, self-employed thing. So, Nick, this is an interesting case, and it's a good one to subject a lot of people to. Nick, do you have any questions at this point? Nicholas, unmute your mic. Old Saint Nick. Anybody have any questions? I must hit the freaking nail on the head if nobody has any questions. I must be fantastic at this shit. Okay, here we go. This is F&G Annuities and Life. Okay, F&G Annuities and Life. Let me see something. Nick. Unmute your mic. You can discuss this with me. For those new people that are new onto this webinar, we're hitting home runs left and right. We're discussing IULs and how to put them into your sales business for more business to be sold per week. There's business you all are walking away from. I see a lot of faces here. I see a lot of faces on Facebook. You're all walking away from an extra $2,500, $3,000, $3,600, $6,000, $12,000. All of this is extra. Why? Because there's a market out there you're not subjecting it to. After you've sold final expense, Nick, you ready? You have any questions you just asked? After you subject your tongue to final expense or mortgage protection sales, what you have here is the youth. We got younger people, guys, to cover because they don't have it. You've got grandparents out there that love their grandchildren more than they do their kids. If you can provide proof that this product will work on their grandkids, they got many grandkids. I've sold a lot of these doing it this way. Doesn't always work, but why not pitch it anyway? Hey, Mr. and Mrs. Jones, do you know that there's a new tax-free, at the time that your grandchildren receive the money, it's tax-free retirement plan out there that I would like to teach to you today? And I would like to provide you the information because we know, you know, that there will be no pensions. There are no 401ks, 403bs. There may not be Social Security, for Christ's sake. So the importance of this product is the future of our company. If you don't want to walk around as an old man or an old woman one day, walking around neighborhoods that used to look good, and now they've got paint on the side of the freaking buildings because everything fell apart. Nobody talked to youth about options. All we're giving our clients is options. Nick, am I doing good, Nick? I can't hear you. Are you on mute? I can't hear you, buddy. All right, any questions, pop them up on the screen. You can also type questions in. And remember that this discussion is strictly about index universal life, leading from a mortgage protection lead and a final expense lead. Think about the price you pay for this. You pay $50 for this, so what? You made $3,600 on the deal. Okay, this is extra above and beyond what you're doing already. 9 times out of 10, you have to understand what mortgage protection means. It means covering the mortgage, covering half of the mortgage, or walking Mrs. Jones out the door. Those 3 things are the only 3 options you should be providing. I can't hear you, brother. I don't know if your cell phone's on mute. He's at LA Fit. So Nick, if you want to talk, just let me know. I'm going to continue and finish this out. Here's what we need to go over real quickly. Let me do this. I'm going to share with you again this. This is vital, okay? Again, I'm going to show you this in a second. You just wait. Here it is, okay? This is, let me try to see if I can get this as close as possible. Now, this is something you all should print out. Do it on yourselves or just make up one. All Fidelity Life and Guarantee. And I can hear you now. Do you have any questions?
All righty.
Am I doing okay?
Man, this is Jason, man, you know, this is so much value. I'm fired up.
It really is. It really is a lot of value. Nick understands the value of this, and all you really should too. This is an incredible opportunity for all of you to go on. Let me tell you about this here. Again, I'm going to jump this because I believe that when Nick goes into this home, he's going to take this individual, as we discussed, from $300 a month to $500 a month. You know why? Because Nick said, you know what, I think he's putting money into his savings too. And if somebody's putting money into a savings account earning 0 interest, why would you let them do that? That's your fault that they're doing that. You allow them the opportunity of using this product to take that extra $100 and fund this policy properly. Note these numbers. Now, because of Nick's education and his leadership towards this gentleman and his professionalism and education, he's taking this guy from $100,000 in 20 years to $200,000. Now, deflecting inflation, adding an extra $10,000 a year on to this guy's income. $22,000, no longer 10 is what this gentleman will earn in 20 years. At the end of the day, here's how it works again. Gentleman funds this at $500. This is at $300. The face amount's not what this is about. It's a very low face amount. It starts at 59 grand for $300. At the end of the puzzle where he stops, the face amount is now worth $159,000. The cash is worth 99. So if he walked away as 99,000, he only put 64 in. Okay, so he's still above the game. He still walks away with more money if he chose to. The account value is where he's going to strategize this part. So he's got what, under 64,000, because this is 64 at age 72. He's starting at age what, 70? So he's like 40 grand in this damn thing. Here's 10,000, 10,000. He's pulled 21,000, 10, 10, 10, 10, 10. All the way through till age 85, this guy will get $10,718 tax-free until age 85. But because we're adding more premium, he's going to get more money. Okay? This is a fantastic strategy. And I'm going to be honest with you. I have walked into places where younger people have said, I said, you have a retirement plan put aside for your wife? And they say, no, I'm about to start a 401k. And I pull this out. I said, don't do that. Let's overfund this. We'll outperform the 401k properly funding this product. At the end of the day, most people are going to retire with a 401k between 100 and 200 grand. With the way the company's matched, the interest levels out there, and the amount that they're funding it out. So no big deal. This will, 9 times out of 10, outperform by twice the amount, usually. Here's another idea. Now, remember this. I told Nick, why doesn't the wife do this? This wife can take this.
3 separate times he kept asking me about the suicide clause.
Excuse me? Somebody asked about a suicide clause or something?
No, I'm sorry.
Oh, you're
Sorry, conversation.
That's okay. Anyway, so at the end of the day, I told Nick that the wife can take this $159,000 out. She now can stuff this into an annuity, which annuities have 15% interest bonuses on them. Now she's at what? 15% on 150 grand is 15,000 plus 7. She's at 175,000 or so dollars, right? She starts at 175. Now she's earning 8% on average on an annuity. So his wife's taken care of. I talk about both of them because why is it not important? What is this for? This isn't just for the gentleman that's getting this. What's his name? What the hell's his name? Brian. Brian? No, that's not his name. It's prepared by Brian. This gentleman is doing this for his wife, his kids, his future. So you have to add in the wife. Get them both involved and make them work with each other and against each other sometimes. Because I'm going to guarantee you they do not discuss, Mrs. Jones, if he died, would you walk out that door with the equity in the home? You want to live somewhere else? And the answer 9 times out of 10 is yes. She would want to move. I'm telling you that the lady doesn't want to stay off it. Now, a lot of times maybe they do, but if they do or they don't, it doesn't matter. You need to know what the hell is going on. And if they do want to stay and they can't afford a policy that covers $300,000 because of the age that they're at, you need to provide them this information. Let's pay off half. Mr. Jones, you look healthy. You're going to live another 15 years. Let's pay off that last 15 years. There's one more strategy that nobody knows that I want to teach you all that may help your clients. This is what I do for clients in the home. Did you know that mortgages can be paid, if you already don't know this, bi-weekly? When you do a bi-weekly payment schedule, instead of paying $1,000 a month, you pay $500 and $500. What happens is the mortgage company will drop the interest rates for getting more money, banks receiving more money, more income. They'll drop the interest rates and they'll get these payments done in 15, 20 years. These homes on a bi-weekly payment schedule can be done in 15, 20 years, meaning this product can be less. You only have to protect them for 15 years, which allows them safety. Now they don't feel like they have to cover 30. This is a big strategy. I'm telling you, mortgage protection. For those of people that are a little on the fence, that don't believe in, they say, I got to cover the 30 years or bust. Or if you don't want to do this, then you need to cover half the mortgage. Or you need to tell Mrs. Jones, are you on the home? I'm going to tell you something right now. You all better hear this. The woman's not on the home. Mr. Jones and the bank are on the home. She doesn't own that house. At his death, this is all probatable shit. She'll lose that house. She'll lose all the equity unless you do your job. And you tell her, Mrs. Jones, you may not be able to live here, but here's the facts. Because your husband was so smart, and you too, man, you guys got a home and you used it for investment. You're earning 3% to 6% annually on the home. You're spending $1,000 a month times 12 months. That's $12,000 a year. Times that by 10 years, that's $120,000. To figure out what's the equity, you just divide this by 2. That equals $60,000. So whatever the monthly payment is on a mortgage, slice it in half. Part of that is equity, and the other half goes to the bank and insurance and shit. That's a good average. So she's paying $1,000 a month times 12 months a year. That's $12,000 times 10 years. He dies. She walks away with 60 plus thousand. Let's say it's $75,000. To do that, she must have time. So your job is to sell a mortgage protection policy that buys her time to get that number. Remember, Mrs. Jones, you might not be able to stay here, but between the policy he's leaving and this number, you'll be set to live in any home you want, basically, within means. So you're just getting people to understand that 9 times out of 10, the woman isn't on home. Her credit's screwed up. She's never built credit. Remember these old school women? They stayed at home. They haven't established credit. A lot of them don't have any money put away. They got low incomes. They can't even be placed on a home, and sometimes it's just not worth it. The old man just puts himself on it. She's not on that house, or the kids, somebody. Doesn't matter if she's on a deed. She doesn't on the payment schedule. She will lose the home because you didn't do your job. Okay? Bottom line, you got to make sure people are doing their job. Okay? Very, 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 very important. All right, how about any questions? I'm going to open the mic up. Any questions? Who has a question? Troy, you got a question. Troy Delegado, he's in the house. He has a question, don't you, Troy? We're talking about IULs, Troy. All right, listen to me. While we're in the indexing market, let's just add in the annuity market. Okay, we might as well. Since we're talking about retirement, you also have the abilities to find money. Let me read this. Your job is to find money. How do you find money? This is the fun part of the sale. Finding money. Just make this whole thing fun. Don't be so stressed out about it. They don't know what you don't know. They think you're the absolute professional. You went to school for this stuff. You're a part of the state. You have all this knowledge. You're able to save their lives, save their homes, save their income, retire healthy and wealthy. Finding money is as easy as saying this. Mr. Jones, what else are you going to be leaving behind to Mrs. Jones or your children? Now, he'll say a 401k. He'll say pension. He'll say cash. He'll say an annuity. Don't forget to ask. Here, let me teach you something. He says a 401k. He's not going to tell you how much is in it. At the time of death, Mr. Jones, what's the value of that 401k to your wife? You see, the language is why I get so many people to tell me so many things. I'm not asking, Mr. Jones, I need to know what's in your 401k. That won't work. Now you're prying. Dude, you're here for mortgage protection. You're asking me about my retirement to tell out of my house. So what we need to provide him is the information that says, Mr. Jones, how much at your death would Mrs. Jones today receive out of your 401k to provide her the future? This is worth $200,000. Boom, you newbies, you have that information now. You write that down. All new reps, write that down, because in the home I'm talking about, when you're in the house, you write this information down. Now, your focus would be on your mortgage protection sale. Just get the sale done. Use your monthly premium paid products to sell this deal. Later on, we can learn how to use the annuities to pay for the mortgage protection. Doubling this, guess what? This guy gets a 15% bonus, right? That's $30,000 extra. I had a woman, Monday, I believe, tell me that she has an annuity worth $100,000. Now, because of her age, she only gets a 7% bonus. But she's making adjustments to her home. She wants to fix the bathroom up. So what I did is I 7% bonus, $7,000 that she gets for free to pay for her bathroom. But now, because she's already in an annuity, she believes in annuities. So I'm taking her from an annuity to an annuity, but a higher interest earning annuity with the theme. I'm going to use the 7%, this $7,000 to do her bathrooms. Okay? Now look at that. She gets her bathrooms done for free. These are creative ways to sell, guys. Very, very creative. And that's what I want you to do. So don't pass up this too. This is another strategy that I learned along my journey. Is I might say that somebody might tell me that they have a 401k, but guess what? You also have other things. A lot of times I would stop there and get all excited, like, oh my God, I found an annuity sale, I'm gonna get paid big money. So I stop here, I get 200 grand here, but little did I know that this guy has 6 other freaking annuities, and he has an IRA too. Because I didn't ask, is there anything else you'll be leaving behind to Mrs. Jones? Remember to make the statement on her. Provide them the information with that you care about Mrs. Jones, and that's why you're asking. Okay? And to do the math, at the end of the day, if you're capable of putting all these numbers together, remember, one big number will make more numbers than all these separate numbers. This market is not diversified. It's not the stock market. It should not be diversified in any way, shape, or form. Put all this shit together in a high interest earning annuity. Sometimes you can split two up. That might be okay too. Most of the time you can just shovel it all in one if they qualify to be jointly together. Remember, what you need to learn about annuities is the words qualified money and non-qualified. Qualified and non-qualified. So write that down and learn that. At the end of the day, we started with IULs. We have an IUL sale here for the mortgage protection. Okay, that's it. Now you also have this. For you newbies, you wrote down that he has $200,000. When you go deliver this mortgage protection policy, you now have a print-up of the annuity. You and your upline worked on this, or should be me. You got a $200,000 annuity that you're working on. You bring that back and you say, Mr. Jones, I found a way to protect your principal. I remember you said you had a 401k, and I don't want to see you drop in the market, but also it pays for your policy. So I wanted to provide you the information at least so you and Mr. Jones understood that you're able to get to, you got $30,000 is your bonus, and then you're going to double your money by the 7th to 8th year, you'll be at $400,000. If you could just wait 7 to 8 years, Mr. Jones, you'll be at $400,000. You know, if all you start capitalizing on things like this, if you can just get to the numbers, the big numbers, you guys can stop and just enjoy it. All you got to do is get some money in your pocket, and then you have bigger numbers. You know, I know that sounds difficult, but it's not. You just have to be freaking laser focused. Your friends want to go out. Fuck you, I can't go. Your woman wants to go out on a date. No, we're not spending money. We need leads. Your kids want a new bicycle. I'm sorry, babe. I'll buy you a golden bicycle a year or two down the line. You got to wait. Everybody has to wait for your success. So tell everybody about it. Tell them I'm going to be laser focused for the next year. However, I'm going to walk away with $300,000 this year, which 100 of it, I'm going to take and stuff away for my future. And if you do that every year for the next 5 or 10 years, you'll be set for life, guys. You're young enough that you can do this. And even for your older gentlemen, it doesn't matter. Most of your older guys are set up anyway. You're just playing. You may be just doing this, to make extra cash, which is cool too. Any questions across the board? Hey guys, my job gets easier when you guys ask questions. I'd like to let you know that. It becomes a lot easier if I get a few questions out of y'all. So, what else? One more thing I wanted to go over. And remember this. Very important that you guys learn how to illustrate. Illustrations are done by contacting the carrier, and you will state that I have a 52-year-old male. They'll ask you questions. They're going to ask you your name, your contract number. You contact the carrier. I got a 52-year-old male, non-smoker, healthy, nothing, boom, 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 need an illustration. However, you need to learn how to do these illustrations because the one I laid out for you has a subject to it, which is called B switching to A. This means that he's getting income at this point. That means at age 52, he started dumping money, and at age 85, he wants that money. Now, if you go A to B, that's just getting money established. It's just stacking dough. You want no money from it later on. However, you can start asking for money even at that point. But I did the two, and it looked like this one outperformed it for some reason. So do your illustrations and check the cash portion of it, the accumulated value. And where you're looking, guys, is over here. See, what you gotta understand is there's 3 tabulatures on here. There's 1, 2, 3, okay? This one is a guaranteed assumption of 0.25. That's your bottom end. You can't earn any less than that. Here's a fixed rate. So you can put somebody in a fixed rate of 4.75 and call it a day. You can guarantee them 4.75. That's great news. The highest one out there is Forrester's 4% to 6% averages, and Transamerica based on 4% on their cash value. This one here is interesting because this is the one that kind of is based upon the S&P, which is okay. This is the one that earns 8.7, 9.7%. It states the average is 7.98. We can say that's 8.7, 9.7%. That's what you got to learn. Not only that, but I subjected you to the values of the past. That page and this page, right down in here, where it says S&P annual point-to-point par participation with 14.5% cap. So he can earn more. It's not like he's stuck at that rate. He's got a bottom end of 2.5. The history shows he's been earning 8 to 9% for 20 freaking years. We've been through bad times, Mr. Jones. It's okay. We'll get there. We'll be okay. Chris, you should get on. Do you have access to the go on my Facebook? There's access to the webinar, and we can discuss that. So there's many IULs you guys can choose from. But why would you choose anything that doesn't have a historics of proving high interest rate earnings for your plan? Along with, remember, what does the L stand for? Remember the index universal life theory here. Look, IUL. This has two parts, living benefits and death benefit. Okay? This is universal. The U means that they can actually stop making payments on this product in 15 years and the cash value will pay the premiums. And they still have the face amount up here. Okay? The index is where we're indexing it to the S&P. F and G, there's LSW. There's even, I even find that the GUL Express and GUL and Smart UL are fantastic for these products. I know we've been on here a long time, guys, and I appreciate you hanging in there. That's why I ask of you to ask questions so I can provide you. No question is fucking stupid at all. Believe me, when I was first in this game, I was a guy at the table constantly writing notes. Not one dude made any sense in the home. I'm giving you reality in the house. That's why I can't understand. If I'm not getting questions, what I can fathom is that many of you may not be in the home as much as you need to be, and you're not getting enough information to give to me to understand what to ask me. And I want you guys to understand, if you're a life insurance rep, and you are not steadily ordering steady lead flow, get out. Just get the fuck out. You're taking time up that is wasted to others, and you're not doing the job. You're not a life insurance rep at all. Please understand that you are a self-employed marketer. We got the leads, guys. These people will answer the phone. I promise you they will answer. Listen, how many appointments you set in an hour today? You set 12 appointments in 1 hour. 12, 1 hour, that's it. Boom, 1 hour. Saturday morning, bang out the phone, 1 hour, guys. Delegate the shit out. Give it to your wife, give it to your girlfriend. Hire somebody, do whatever you gotta do, but get in front of people. Weekly. I won't sell 12. God bless me if I do. I sell half of that at premiums between $100 and $500. That's my $10,000 a week, guys. 5,000, 10,000, even 20. I find annuities, it could be 100 grand. You find these numbers really jack up when you ask questions in the home. There's no difference in buts whether these people have money. They got money. You just need to find it. I got people that have $2 million and they trust their stockbroker. They told me that they would rather lose money than leave him. What the is that? I don't get it. I just don't get it, okay? But what I didn't do is I didn't provide them enough information. So if you're going to get into the annuity market, IUL markets, please get on Google. Provide these people with death statistics, heart attacks, strokes, cancers, people that smoke. Chris Smith, you had a question. What is it? I'll be there in a minute. Chris, unmute your mic there, buddy. Let me see if I can do it for you. Chris, you had a question? It was, what the hell was it anyway, buddy? I unmuted your mic, Chris. Chris Smith. Chris Smith, can you hear me? Hey, talk up, bud. I had a question. Can't remember what that was. By the way, if you were to find this deal, and let's say you're at 5% count level, just for whatever, that's a $100,000 deal for you. There's your 100 grand. Do you not believe that there's people out there with millions of dollars? Because there is. I can tell you. I run into it. The portion of this puzzle is then report to the point of trust with you, and report to the point of trust on the history of the policy that you're sharing with them, the product. The history is what sells it. The future is what sells it. The principal protection is what sells it. Start protecting families, guys, and go in there and make sure that these individuals understand that the principal protection is what they need. They must have it for their future, and if they lose it, the stock market crashes by 50%, you lose $1 million, Mr. Jones and Mrs. Jones. I got women that have never done a damn thing in their life sitting across the table telling the mister, who earned all the money, by the way, and believed it was their stockbroker that did it. You know what put $2 million in this guy's bucket was him. His matching in his company, not a stockbroker. Stockbroker might have a little bit to do with it, but in many cases, I don't see many high-end stockbrokers working with people that I work with. You know, the people that work with athletes and famous people and shit like that. These are just guys that just, you know, they might have a C300 Mercedes messing around with people's money, earning 3% annually. Any more questions? It's, by the way, Chris Smith, I don't know where he went, but just to answer your question, that is, you got your F&G products, North American, you've got LSW. But if I were you guys, if you want to get into this market, stick with the GULs and smart ULs. Just mess around with the UL market. Discuss living benefits on a heavy basis. This is how it works. I don't know if this is, without questions, I don't know what angle to come at. So if you all, if I were to pick any of you and say, walk into the house, order your leads this week, as I've done, you realize what those leads cost me. You know, that's $600 there. For me to make 5 or 10,000, does that make sense? You understand? So that's not even what I ordered. I ordered more than that, and that's all I set so far. But that was her hour. That's it. Later on, she might set more. At the end of the day, you got to order your leads, man. I can't tell you how vital this is. You can't get into this business without this. And I know many of you may be struggling, but I'm going to tell you a story. I didn't start off big-time leads. I found a territory through my agency that nobody was going to. I knew it was open. This huge area that nobody would drive to because it was 2.5 hours away every day, 6 days a week, for about a year to get me out of the hole. No bullshit. I was about to lose everything. Now, I got her involved, and the numbers started changing. I was able to delegate things out. Delegation is a business. I got to remind you all own a business. Stop thinking as a salesman and start thinking like a business owner. What would a business owner do? Hell, they'd open a storefront for $2,000, $3,000 a month. If you're in the right territory and right demographics, let people know you're there. You're the financial retirement wizard. Why? Because you protect principal. You give them earnings, but you protect principal. You also have the ability, remember, one more thing I'm going to point out, is when you're in the homes, with annuities, I don't want to confuse this too much, but with annuities, you can pay off people's debts. Do you realize that $2 million that I was talking about at a 15% bonus would be what? That's, what is that, $30,000? How much is that? 15, 10%, 20, 30,000, 60,000, $60,000 bonus, I think, right? So you get $2 million, $60,000, or 600,000. 2.6. You got 2.6 million, right? So we paid off his mortgage with a bonus. Long story short, you can use the bonuses to pay off the mortgages. Remember that. I hit that home run all the time with annuities. You can pay off mortgages using the bonuses only, and people love that. All right. Any questions beyond this point? Any questions before I go? I'm gonna tell you something too. Watch out for the insurance guy, man. I used to be ripped up and shit. Look at this. This is a mess. I gotta get to the gym. I started for like the first day. Every day's the first day, so I'm gonna try to do it right. I want you guys healthy. I want you ordering leads. If you do have any issues, please text me. Feel free to text me, and let's discuss them one-on-one. Let's discuss a plan for you. I got a plan for you. You just have to trust the system. See, you're not trusting in the system. You've been burned before, the leads suck, things like that. You have to understand, a lot of leads suck, guys. You're only looking for a few sales. That's all you need weekly. You don't need everybody to buy. So get involved. Let's get you trained. Let's learn some new products too. Products are important too. Probably some of them won't get products too. So with that being said, Great. Oh, thank you. I appreciate that, Daniel. Great show, he said. Great show. Thank you very much. Hey, thank you on Facebook. I will see you every Saturday at 10 a.m. for Daniel One Brokers Mortgage Protection Mastery. Right? Home run. Peace out. I'll smoke a blunt and take the pain out. I'll probably try to blow my brains out. Hopeless. They should have killed me as a baby. I'll turn this shit off here. Oh, yo, everybody, goodbye. I'll talk to you. Hello.